They're using a small set of, let's just say elite values and imposing that on all of their owners of capital, even though their clients, most of those owners of capital, don't actually agree with the values that they're advancing. That's a fiduciary breach. I think it is the largest scale fiduciary breach of the 21st century.
One of the primary themes across corporate America and financial markets over the past several years has been environmental, social, and governance, commonly referred to as ESG initiatives. It's a worthy cause, and these efforts can have tremendous benefits for our society. But has this powerful trend gone too far and created unintended consequences? Today I'm joined by Vivek Ramaswamy, co-founder and executive chairman of Strive Asset Management, to discuss these consequences as well as the opportunities he sees for a post-ESG world. Vivek, so great to have you here today.
Yeah, good to be on with you.
So as we all know, there's been a major push towards environmental, social, and governance issues over the past decade. Really, those have picked up over the last 4 or 5 years with major asset managers like BlackRock throwing their hat into the ring. But I guess my question is, have the incentives for investing been distorted by these recent environmental and social trends?
I think it's a great framing of the question. I actually think the incentives are massively distorted because we've conflated a good marketing strategy with a good investing strategy. All right, so there are owners of capital out there who want to advance not just financial goals, but social goals with their investments? Sure. Actually, CalPERS is a large pension fund that is pretty clear that it only wants to do business with investment firms that adopt these firm-wide commitments. Other pension funds and other institutional pools of capital say the same thing. Well, what the BlackRocks of the world realized is that this was a gravy train for raising funds, and their business model is a scale model. They don't charge high fees on their index funds and their passively managed funds, but they require mass scale to get there. So what they recognized was that there are large pools of capital out there that demand these ESG mandates. Great, let's go raise capital from them, but we want a bigger market than just the big guys who mandate this. We want to go to everywhere else too. And so we need to come up with the story for why this is also a good investment strategy. And not just a good investment strategy, because people think of ESG investing as screening in and screening out good and bad stocks.
Right.
That's part of it. But actually the bigger part of the story is using ESG standards in your proxy voting behavior and in your shareholder advocacy and shareholder engagement behavior, which applies to all of their funds, not just the ESG funds, but all of their funds that still vote their shares and that still advocate on behalf of their shareholders, their clients in corporate America's boardrooms. So that's kind of how this was born, is they had to first do this as a marketing strategy. It was a brilliant marketing strategy. After the 2008 financial crisis, which I think both you and I had different experiences in the hedge fund world living through and watching, after the 2008 financial crisis, there was this new demand of American capitalism, something else other than the greed is good mantra. ESG filled that void. So they picked up a good cultural tide for raising funds, but they conflated that with A, good investing strategy, and B, a shareholder advocacy strategy and proxy voting strategy that had nothing to do with creating value, but everything to do with justifying the marketing strategy that allowed them to raise funds from places like CalPERS. So are there distorted incentives? You bet there are. And how do you know those incentives are distorted? When they go to other parts of the world, say China, they completely drop the ESG lingo. There's no ESG mandates or anything in China. In fact, if you go to Chinese companies and say abide by an ESG standard, the CCP is going to tell you, well, I'm sorry, we don't want you doing business here, and you lose your license as an asset manager. Right. So BlackRock actually has the largest foreign-owned asset manager in China, but they had to do a lot of work to gain that license. So the incentive over there is, we don't want to apply ESG or else we lose our ability to do business in China. But then let's apply it in the United States where we get more favorable marketing treatment, and I think even at the margin, more favorable treatment from regulators as a consequence. So there's incentive distortions all the way down. The good news is when the pendulum swings so far in one direction, though, the point isn't to just sit around and complain about it. And I said it's kind of funny because I wrote a whole book about this topic. I write about this topic, but I was sitting around saying, okay, why am I just writing about this? I've been a hedge fund manager before. I've been an entrepreneur. Let's solve the problem. Ultimately, if that's a distortion in the market, you solve a distortion in the market by providing a market solution and taking advantage of it as a way that actually pushes markets back to equilibrium.
Well, you mentioned, balancing profitability. In your view, how should investors think about sort of that balance between profits and the ESG initiatives? Are they mutually exclusive, or can you achieve both?
I mean, I don't even think you can say they're mutually exclusive because ESG has become so ill-defined. I think one of the conversations I asked to an ESG proponent is, what does ESG actually mean to you? Because the term has been purposefully contorted to mean different things in different contexts. But I have a view. If you're managing someone else's money, not talking about investing from your own account. Investing from your own account, you can do whatever you want. But if you're managing someone else's money, you have a sole interest and sole obligation to maximize financial return, period. Not a mixed motivation to say I'm going to maximize financial return and something else. Maximize financial return, period, unless you've been mandated by the owner of capital to also advance whatever their objective is. Not your objective, but their objective. And I think what I see in the large asset management industry today, BlackRock, State Street, Vanguard, but it's not just those three guys. It goes down the list. Invesco, Neuberger Bergman, you name it. All of the signatories of the Climate Action 100 Plus network, the $60 trillion of AUM in the asset management industry, represented by the signatories of just that one group, of which there are many, is that they're using a small set of, let's just say elite values and imposing that on all of their owners of capital, even though their clients, most of those owners of capital, don't actually agree with the values that they're advancing. That's a fiduciary breach. I think it is the largest scale fiduciary breach of the 21st century. Between 20 and $60 trillion of capital, of asset managers using other people's money to advance values in corporate America's boardrooms that most of those owners of capital do not agree with. That's a gap.
I think that's an interesting point that you make because, it's not just the funds that are in the ESG vehicles. As you mentioned, it's, BlackRock or State Street can do this across, all their mutual funds that they hold, whether or not ESG is part of the mandate or not.
That's what people miss. And that's what people miss. So just talk about a fact here. The numbers are approximately right. As of a couple months ago, I looked at this, but about less than 3% of BlackRock's outside managed AUM is in its ESG dedicated investment strategies. Okay, so people who put money into a BlackRock fund saying they wanted to invest in ESG, that's less than 3% of BlackRock's AUM as represented by externally managed capital.
Okay.
But they use effectively ESG-linked proxy voting guidelines and shareholder engagement guidelines on 100% of their capital. That's the disconnect. Presumably, the other 97% said, I'm not selecting an ESG-linked investment strategy because I just want to make the most money possible. That's why I'm handing over my money to an asset manager. Well, if they're using other mixed motivations in the boardroom to help address maybe really important issues, right? Addressing global climate change, solving historical racial inequity, whatever the goals may be, we ought to address that in the civic sphere of our lives, through the political process, through citizens coming together and grappling with how do we tackle these complicated questions. I'm not saying that's not important to do. I'm saying that is important to do. Right. It's so important to do that we should leave it to citizens to do that, rather than putting that duty in the hands of one financial institution on Park Avenue in New York City. Yet that's what they've done, even in a way that most of their own clients didn't recognize was actually happening, because they thought, I'm not investing in the ESG linked strategy. That's just somebody else, 3% of the capital that goes into ESG investing. But they're using those advocacy principles, proxy voting guidelines, for 100% of the capital base. And that's what's created this problem at such a large scale that I don't think it's just a fiduciary breach in the way that I described. It goes even beyond that. The fiduciary breach that I described is, okay, you're using someone else's money to advance values that someone else doesn't agree with. That's the base problem. Right. But now it's happening on such a scale. I mean, just the top three, okay, they manage over $21 trillion. That is approaching the value of approximately similar, if not the same, as the US GDP, okay? And if you imagine, so I spoke on the largest US energy, or one of the largest US energy conferences of oil and gas CEOs in Denver, Colorado. And here's the thought experiment I gave them. Imagine all of you got together in that room across the hall and coordinated with each other to reduce oil and gas production, and then prices spike at the pump as a result. Mm-hmm. We have a word for that. That's an antitrust violation. It's a cut and dry price fixing violation. Maybe the stuff in movies. Some of you might be doing perp walks in handcuffs, getting out of this hotel, okay? But now, this is where the thought experiment turns into reality. Suppose that your public companies are all owned by the same handful of shareholders and institutions, and they're mandating you to behave that exact same way. Today, we live in a moment where that gets celebrated as ESG instead. That's a disconnect. Right. So it's this fiduciary breach. It's a problem happening at such a scale that I think it verges on an anti-competitive issue. Actually, Arizona's Attorney General, Mark Brnovich, very recently just launched an antitrust investigation into ESG-linked asset management practices. I'm very interested to see where that goes. But the part that bothers me the most is those conflicts of interest that I alluded to earlier between, say, the practices in the US and China, where, let's say BlackRock votes for 3 directors on the board of Exxon, as they did, and State Street and Vanguard did too, that after those directors were seated, revised Exxon's climate change strategy. And part of what that entailed was reducing oil production from their prior forecasts. Before the directors were seated, Exxon's business plan was to increase oil production 25% over a 5-year period, 2020 to 2025. Okay. After they got seated, Exxon changed its business plan to reduce its forecasts by 20% relative to those prior targets. Well, guess who's at the front of the line to pick up some of those projects? Other companies, including companies like PetroChina. Now, the cherry on top, guess who owns about 6% of PetroChina as one of its largest ex-China shareholders?
BlackRock.
You nailed it. None other than BlackRock. So in this case, we're saying, I'm going to advocate aggressively here using ESG principles to get Exxon to drop a bunch of projects with the left hand.
Right.
But with the right hand, with Chinese clients owning Chinese companies, I'm going to have them pick it up without saying a peep about ESG over here. The investors in this hand are left holding the bag. I think there's a much smaller version of that problem happening even within the United States. The interests of CalPERS in California may not be the same interests as those of Texas or those of Indiana or Ohio or West Virginia. And yet what's happened is that one asset manager or group of asset managers who wants to service the environmental and social goals advanced by the state of New York or CalPERS is also taking everyone else along for that ride because they're using the same proxy voting principles and the same shareholder engagement principles across their entire capital base. That's a problem. And you want to know one of these funny things about these ESG ratings that are applied to companies today? Not a lot of people know this. If Amazon adopts a certain behavior and burns the exact identical amount of fuel, in the ESG scoring, they're treated more favorably than if Chevron does the exact same thing just because they're an oil company. I mean, does that make any sense to you? It makes, I mean, from an ESG perspective, the title of the company and the way you're labeled ascribes a greater sin score than US tech companies. Now, what does that do? It makes you eligible for investment from ESG funds. But I think that the difficult position for the BlackRocks of the world is now they're trying to be everything to everyone. When you try to be everything to everyone, you're in fact nothing to anyone. But that has created such distortions in the flow of capital that it's created an opportunity for new market participants to then fill the void that they've created.
So with all these changes with investor behavior and changes from the regulatory perspective, what are the implications for the energy sector?
I look at this specifically, right? Let's take what is the sector that has been most damaged by these ESG demands imposed by shareholders? I think there's a strong case, it's the US energy sector, where US energy stocks now trade at a meaningfully lower multiple than they have historically over the last 30-year period, lower than the S&P 500, significantly lower than tech, directly as a consequence of the ESG investment consensus, directly as a consequence of the ESG mandates imposed on this sector. People forget that as recently as 2013, before the ESG demands began taking off, the largest company in the world by market capitalization was not Apple, it was not Google, it was not Amazon, it was not Microsoft, it was not Saudi Aramco, which I believe are the top 5 today. Everyone assumes that's got to be the permanent fixture. As recently as 2013, it was a US energy company, it was ExxonMobil. Now, I think the ESG demands on the sector contributed to massive multiple compression. If you invest and mandate companies to internally invest according to a worldview that says fossil fuels should go away and thus will go away after 2030, well, what do investors say? For every unit of profit that you generate today, I'm still going to pay less in terms of share price for that. That's what the price to earnings multiple is, the unit of price that you'll pay for a unit of earnings today.
Yep.
I'm going to give you less credit for that because I'm going to presume those profits are going to disappear. And why am I going to presume that as an investor? Because the companies are already behaving that way. They're underinvesting in their own long-run production capabilities because that's what the ESG-linked investors mandated them to do in the boardroom through the Exxon proxy votes, through the Scope 3 emissions caps that the big three voted in favor of in Chevron as recently as 2021. Why would it be that BlackRock, State Street, and Chevron and Vanguard would vote in favor of Scope 3 emissions reductions in 2021 at Chevron? Why is a Scope 3 emissions cap in the business interest of Chevron to adopt? And I think it's worth saying what a Scope 3 emissions cap actually entails.
Absolutely.
Yeah. So Scope 1 is limiting your own emissions. Scope 2 includes your own emissions plus purchases of electricity and other sources of power. But Scope 3 involves you taking responsibility for the emissions of anyone upstream or downstream in your supply chain. The costs of your employees commuting to work, the carbon cost, counts towards your Scope 3 emissions. Business travel for your own employees. But even the Amazon Prime truck that delivers food to your house, those emissions, according to Chevron's Scope 3 emissions caps, should be counted by Chevron against its own mandate. The truck that delivers an electric vehicle to a dealership and the electric vehicle comes out as the climate change hero, the truck that burned that fuel counts not against the electric company's Scope 3 emissions cap, because presumably it doesn't have one, but against Chevron's Scope 3 emissions cap, as literally reading the Scope 3 emissions reductions targets imposed by shareholder resolution in 2021 at Chevron. Why? Here's the sole question we should be asking as a shareholder of Chevron, as a voting shareholder at Chevron. Why is that in the best interest of this company to assume responsibility for everyone downstream in its supply chain while they're relieved of that responsibility? Answer, silence. I've never gotten a good answer to that question. I don't think BlackRock, State Street, or Vanguard have had a good answer to that question. Well, if this is the direction that the large shareholders are taking this industry, yeah, maybe they should trade at a lower multiple. My view is if there's a new post-ESG mandate to this sector, not only does that better represent the will of many American owners of capital, it also unlocks the potential of the U.S. energy sector, re-rating the multiple at which these stocks trade.
So it sounds like, in your view, that a lot of these forces have driven the energy sector to see massive underinvestment.
My view is a few things have changed this year, and we can talk about them. I mean, Russia's invasion of Ukraine, a looming massive supply-demand imbalance in the course of energy. I'm not talking about how that plays out in the next 6 months, but I'm talking about how that plays out in the coming years. That's awakened investors to the reality, and I think it will continue to awaken investors to the reality that oil and gas is not going anywhere after 2030. I think it was less than a 3.5% market share change in terms of global energy usage over something like a 30-year period, and that was the lowest hanging fruit of the so-called transition. People talk about the energy transition. If you look at those numbers, on that math, I think it would be false to even call it a transition. There's on the math of it, there's not a transition happening. And if to the extent there was, it was the lowest hanging fruit and it was still really small. Oil and gas isn't going away anywhere, demand for it included, after 2030. And if U.S. energy companies can start investing for growth today to fill that void, these companies should trade at multiples that reflect a higher terminal value in the distant future, which in turn affects the PE multiple at which these companies trade. So motivation is, it was all part of the same goal, better represent the owner of capital's voice as a shareholder, but by doing it in the boardrooms of energy companies, this is one sector where we can actually unlock real value. Usually you see that in the format of private equity funds or hedge funds or 2 and 20 alternative asset management vehicles that you and I know well and I've been a manager of before. But this time, we wanted to make this available in the format of an index fund because we want to actually build a movement in capital markets to provide this change of direction away from ESG mandates, hopefully demonstrate that proof of concept in delivering positive change in the energy sector, and then take that model to one other sector at a time, where we've also seen other kinds of dislocations introduced by the ESG movement.
What is a catalyst where you see these sort of valuation multiples re-rate? You know, if you look at financials, there's no question that the regulation and sort of everything that unfolded after 2008, financials still today, I mean, even with massive earnings, are trading at 20, 30, 40% discount from pre-GFC multiples. So is there a specific catalyst that you have in mind that could unlock this sort of aha moment?
It's a great question.
Or is it more of a structural over time?
Well, I think the way I think about catalysts is you can never predict them in advance. But when the structural case is, it's like sort of a hair's trigger away. There's gunpowder in the air. I can't tell you which match is going to light the conflagration. But I think that there's a number of possibilities. Okay, I think the end of this year could be pretty interesting. There's the much discussed Russia-EU oil ban, the EU ban on Russian oil imports, on Russian exports to the EU importing Russian oil. Well, that only goes into effect in December. I think that will be a massive supply shock, a global supply shock that much of the world, including Europe and the United States, is not ready for. I think the United States knows it's not ready for it because Biden was actually, ironically, one of the world leaders quietly lobbying the EU not to adopt an EU oil ban, actually, on Russian oil. Pretty interesting. So I think that's a catalyst. Around the same time that I think we're also going to see a demand shock. What demand shock is that? I think there's a lot of concern in the bull-bear case for U.S. energy stocks here in the United States about the U.S. recession or not. Valid debate. However, look on the other side of the Pacific, China's been locked down. Those lockdowns are now easing. It's finally, and I think part of the lockdown was keeping things calm before Xi Jinping takes a third term, an unprecedented third term as chairman of the CCP. That happens in October. That's a big part of why he was just in a mode, he doesn't care what happens to the economy, keep everything quelled. That's a really big moment that has a lot of global implications we could talk about for hours another day. But anyway, after that, I think that that's going to also be a catalyst for lifting a lot of the restrictions in China, loosening those restrictions on the coronavirus lockdowns. That's a demand shock hitting right around the same time that I think we have this EU ban on Russian oil actually kicking in for a supply shock that the West is not prepared for. I think a demand shock with a supply shock at the same time is quite possibly the beginnings of a major catalyst that re-rates the multiple applied to companies that can fill that void, especially if they start investing. And bluntly, I think the launch of DRLL, and the rise of post-ESG investors like Strive. This is going to be an issue that is going to be a core focus of mine and others in this movement over the coming months, including over that same period. The delivery of this new post-ESG shareholder mandate to the sector, causing companies to even think about, boardrooms to think about behaving and changing their corporate behaviors, that in turn affects the way that investors actually value the companies. Right. Investors can't say, I'm going to give you credit for something after 2030 if you're not making at least even smart, but minimal CapEx investments to be able to capture that opportunity. So I'm not saying that these companies should return to irresponsible CapEx spending willy-nilly, but now in a focused way, after they've, I think, all been disciplined by the sins of overspending in the 20-teens, to now say, okay, we're going to measure the ROI, but if the ROI is really positive over the long run, you're darn right we're going to invest in more oil production, in more exploration, in more refineries, in more natural gas production, drill, frack, do it, even if that violates the norms and demands of the environmentalist prong of the ESG movement. And I think that delivery of a shareholder mandate and change in behavior amongst oil companies, and I will tell you, they are hungry and waiting almost for an excuse from new shareholders like Strive to be able to deliver that mandate, because they're sort of overbrimming with readiness to run in that direction, combined with this supply shock, combined with the demand shock, combined with other demand shocks, like the fact that the U.S. Strategic Petroleum Reserve, for better or worse, is at the lowest level it's been since 1985 in over 30 years, in over 35 years. That's a problem. And there's only one way to fill the Strategic Petroleum Reserve. It is by buying oil. Now, I think in this debate I have with colleagues and friends, one of the things they point out is even if we're successful in lifting these shackles from the ESG sector, and from the ESG movement in the private sector, what about the public sector, right? You still have regulations that are shackling this industry. Doesn't this ignore that? I think it's a good and valid point. I'll share with you my view. I think, and I do not think that this is priced in. I do not think markets have caught up to this yet. I think they will catch up to it in the coming year. The regulatory winds are shifting from headwinds to tailwinds for this sector. So this is my law background and whatnot, and I like to geek out on Supreme Court cases, but there was a big one on this spring's docket, where the Supreme Court held that one of the EPA's regulations on the coal industry was actually unlawful, in a certain sense unconstitutional, because the EPA exceeded the scope of authority that Congress had granted to the Environmental Protection Agency, the EPA. If you read that legal reasoning very carefully, you will realize that if that's unconstitutional, much of the regulations applying to the entire energy industry through the EPA and other administrative agencies are also unconstitutional and unlawful, exceeding the scope of what Congress explicitly put in the statute. So what's the fix for that, according to the Supreme Court? It would be for Congress to adjust the law in a way that actually includes that scope of regulations. After this November, that ain't happening. And in fact, there's going to be political winds and pressure that we already see on the Biden administration slowly softening its stance on production and land leases and drilling leases and refinery leases here at home. I think the markets will catch up to understanding the impact of this. So those perceived regulatory headwinds are actually tailwinds, which isolates for the ESG shackles imposed on the sector. I think new shareholders, like Strive, through DRLL, that is part of what we're capturing, to say that we're going to offer exposure to the same U.S. energy companies, publicly traded large U.S. energy companies that you know and love.
Right.
But bring this different shareholder mandate to the table that changes the behavior through the boardrooms as well, at a time when you have a lot of other tailwinds in the market for the sector, from the supply-demand shock all the way to even the policy tailwinds and the regulatory tailwinds starting to actually work in favor of the sector rather than against it.
One of the things that I think investors need to think about is what's going to happen after sort of this supply shock, demand shock sort of dissipates, right? I mean, we're already seeing Europe and to some extent here in the US, policymakers going back towards nuclear energy or even coal. You know, we're seeing coal plants reopen.
Firing up in Germany as we speak.
Yeah, so it's interesting because is it just sort of the short-term blip to bridge the gap, or can these energy sector issues be remedied while also furthering the goals of the ESG issues?
Yeah, as I said, the ESG issues are fatally vague in terms of how well they're defined. So I prefer to be more specific rather than using a three-letter acronym that's designed to cover up for vagueness. So I think, look, one of the frames that I like to talk about is molecules versus electrons. U.S. energy companies have competitive advantages in harvesting molecules, hydrocarbons. That's different than electrons, like solar energy or other modes of electric-powered future, okay? That's a wasteful form of investment for U.S. oil companies and gas companies to be focused on transitioning to solar energies. They have no inherent competitive advantage there. However, there's a conversation to be had about how do we use pipelines for, say, hydrogen? How do we use carbon recapture? How do we actually capture methane that's released, liquefy it, sell it as natural gas? How do we put more carbon back in the ground and actually not just make it a renewable resource for society, make it a renewable source of profitability for ourselves? Those are valid conversations to have. And would someone call those ESG friendly? They probably would. I call them actually purpose-oriented, excellence-centric, what we call excellence capitalism at Strive as a contrast to stakeholder capitalism. That is excellence capitalism. It is also synchronous with some of the demands of the ESG movement. That's great. I'm in favor of that. But I think that that's got to be the lens through which we look at this, as opposed to the low resolution lens of there's some vague energy transition and climate transition coming, spend money on wind and solar as a way of virtue signaling, even though those are low ROI investments. It reminds me actually of a lesson that this industry has learned time and again. Exxon, and I think it was the late 80s or early 90s, made a misadventure where PCs were the next hot thing, right? Apple, Microsoft were born as big PC companies. They said, let's start a division of Exxon that might focus on PCs and the PC revolution. Exxon Information Systems blew a boatload of money on that. It was, of course, as you'd predict, a donut with respect to return on investment. And then, they came back and ultimately decided that wasn't where they were going to focus because Microsoft and Apple had that covered. So it's sort of it's a unique industry culturally, that because society has always loathed it, engaged in this form of self-loathing that they bent the knee to, try to spend money on the shiny thing, waste a lot of money, learn the lesson. I think that's what wind and solar represents right now.
Okay.
But I also think that, back to the core point you were raising, there is this, I think, potentially short-term supply-demand imbalance and shock that could be coming to a head later this year. But that's here to stay, because part of what's contributed to that supply-demand shock isn't just Russia's invasion of Ukraine. It is, over the last 7 years, systematic underinvestment by U.S. and Western companies, Canada included, Norway included, Western companies in oil and gas production. That will not change on a dime. What I'd like to see is energy stocks being viewed from this value stock dividend yielding universe to potentially an area of growth, kind of what we at Strive call the great reversal between views of the tech sector over the last 10 years. Energy can be a growth sector over the next 10 years if these companies, in a disciplined way, are actually investing for growth for a fossil future that is not going away after 2030. That was a convenient thing to say in 2013, 2014, and 2015 when that seemed far away. The closer we're getting to 2030, we're not even close. It's gonna be decades, it may be centuries before we actually transition away from that. That's not what's baked into these stock prices.
Right.
That's not what's baked into a 10 or less PE multiple applied to this sector. And so even though those issues are in the longer run, I think the short run supply-demand imbalance should be a catalyst for investors to rethink how they value the long run.
Understood. Well, I'm glad that you mentioned that, because I think some of the headlines on Strive are a bit misleading, because you're not saying you're anti-ESG. You're saying that there are some very worthy causes, and we shouldn't completely abandon those. It's just being smart about where the capital is being allocated.
Exactly.
To the most efficient people with the competitive advantage.
Totally. I mean, you're not going to find a more, I'm among the most pro-nuclear energy proponents you're going to find, okay? It is a mystery to me that certain ESG funds, like Vanguard's ESG funds, for example, by rule, exclude nuclear energy companies. That, to me, even if you're thinking about, on the other side of this, the actual possible climate transition, what's the most effective form of carbon-free energy generation? There's no doubt it is nuclear energy. So it's a mystery that the so-called ESG movement itself has been hostile to nuclear energy. I also believe that even with respect to the preparation for a transition to even if it's a long-run future that involves much less carbon emissions, that can be a source of profitability for energy companies if they're investing in areas where they have a competitive advantage. Hydrogen, carbon recapture, putting it back in the ground. So I don't call it anti-ESG, I call it post-ESG. This is a post-ESG mandate. In the US energy sector, and I will tell you from the conversations I've had with oil and gas executives, they're hungry. They're waiting in the wings to march to the beat of a new shareholder mandate. There just isn't a shareholder that's vocally delivering that new post-ESG mandate. That's the vacuum that we want to fill with Strive. And I'll tell you, our first idea was actually to launch a different ETF first. Our first product naturally was going to be just a large cap tracking index. I actually said, you know what, the moment is right, not just in the US energy sector, but also to pick the one sector where we can demonstrate how one can unlock value by going beyond this ESG investment consensus. And I'm glad we did. I think it was the right place to start.
So I think you've done a great job of laying out the case for the energy industry and specifically how Strive can help investors unlock that value. But before I let you go, can you just give us a sense for what other opportunities you might be looking towards in the future, in the next couple of months, quarters, as you look to sort of expand on this, exceptionalism, capitalism, as you said?
Well, this will be the first of a series of passive funds that we intend to launch. I also think that there's a long-run opportunity in actively managed funds that take advantage of market dislocations created by the ESG movement. But I'll give you kind of a 50,000-foot view of an opportunity that I see across the American economy. I think there are 100 to 150 million American consumers, including investors, who have been forgotten by the large asset management firms, but by mainstream companies in one sector after another. And I think one of the defining economic opportunities of our generation is to see that if you're able to approach those customers in a way that respects their actual wishes, you'll recognize that many of those customers are some of the best credit risks, some of the best investors in terms of investable capital, some of the most loyal consumers with growing and staying buying power and investment power, that could be the backbone for building the next generation of large cap companies by serving that base of everyday Americans that have actually, I think, been forgotten by a lot of companies, from consumer products companies to tech companies to companies across other sectors. And so what we want to do here is demonstrate how we can unlock value in US energy by better representing the voice of that everyday citizen in the boardroom. But I think that opens up a broader, I think, cultural revival that could be unifying for our culture by saying that we're going to depoliticize corporate America and include this base of 100, 150 million great customers and investors in any business. I think that's going to be a source of value creation. It's a source of arbitrage in the sense that many businesses have not explicitly targeted some of the most valuable customers that they possibly could be targeting. But I hope it also is unifying for the country to say that, you know what, we may have our political divisions out in the field of partisan politics, but the private sector is actually a place we can come together to innovate together, to create things together, to build things together without regard to black, white, red, or blue. It doesn't matter. And And I hope that will be a boon, not just for American capitalism, which is part of what we hope to bring to the table as an asset manager, but personally speaking as a citizen, also a boon to American democracy. And I think that by saving American capitalism, we can do something important for American democracy at the same time too. And I know that sounds grandiose or whatever, but it's actually my motivation for doing this. I didn't think I was going to be starting another business. I was writing books. I thought I was done with my business career. I wouldn't be doing this if I didn't think we had an opportunity to at least contribute to that.
Yeah, I mean, that's a great point, and hopefully there are some substantial changes being made. But Vivek, thank you again for stopping in today.
Thanks.
I think you've made an excellent case for not only the energy industry, but how the world views sort of these ESG initiatives. And I really look forward to seeing what Strive has planned next.
Thanks. I appreciate you having me. Thanks.
I hope you all enjoyed that conversation with Vivek. That's not your typical viewpoint you hear during ESG debates, but he makes some compelling arguments. At Strive, they're currently focused on opportunities in the energy industry due to severe underinvestment, but they also believe that their efforts can have wide-ranging implications that extend beyond financial markets.